Good afternoon, everyone, and welcome to today's complimentary webinar where we will discuss the implications of the U.S. government shutdown with Dr. Lev Borodovsky, Chief Risk Officer of Star Mountain Capital and the editor of the Wall Street Journal's Daily Shot. My name is John Polis, and I'm the Chief Operating and Technology Officer for your webinar host, Star Mountain Capital. We are a specialized asset management firm focused on investing in the U.S. lower middle market. We employ a data-driven approach to provide value-added capital to finance growth initiatives of established small and medium-sized companies. Our collaborative ecosystem is powered by custom-built technology and a deep and experienced team that has been investing in the lower middle market since 2001. Before I hand over the reins to Lev and Matt, I did want to let you know that your audio is muted and will be for the entirety of the presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or webinar materials constitutes an offer to sell or a solicitation of an offer to purchase by Star Mountain interest in any investment product. We have allocated time at the end of the presentation for Q&A. If you have a question, you can type it into the Q&A chat box of your WebEx client. We will try to get to as many questions possible before the end, before our hour is up. So, Lev, a lot has transpired with the global and domestic economies, money, politics, etc., since our last discussion at the end of September. Most indications are that the U.S. economy remains strong. We are very interested to hear your thoughts regarding what the impact of the government shutdown has had and is having, and what another possible shutdown in 3 weeks might mean.
Great. Thanks, John. So what I wanted to do is talk about some trends that we kind of been monitoring to see, how much of the impact came from the government shutdown. It's important to note that there are multiple macro trends taking place over the last few months, and making this shutdown timing just absolutely terrible as far as kind of the overall economic picture. But also for analysts, it's a little more difficult to tease out what is the impact of the shutdown versus other trends that are taking place, such as the trade dispute with China, and global slowdown, which is basically pushed around the stock market, bringing it close to a bear market territory last year, and had all sorts of other impact on the economy. But we're going to try to talk about some of the trends and see where the touch points are for the shutdown. So here's kind of a quick outline. Let's briefly touch base on what were the disruptions. What did people see that was were some of the biggest changes in the way people do business in since the shutdown started. And then we'll talk about consumer confidence and the impact on consumer confidence, which is dramatic. Business sentiment, the stock market, the impact on consumption. So does the weakness in consumer confidence, is that trickling into consumption and retail sales and things of that nature? We'll talk about the labor markets and what we see or don't see in the labor markets. And finally, the GDP impact of the shutdown and what economists are saying, was so far has been the impact. And then we'll end it with the question of whether this shutdown is over or whether we're going to revisit this in another couple of weeks. So let's get going. So let's talk about some of the disruptions. The chart on the right, and again, there's not much language here. It's just going to be a charts as usual. So the chart on the left is it shows the uh, the the number of employees who are the percentage of government employees who have been calling in sick during the shutdown. As you can see, as the shutdown went on, more and more employees relative to the previous year were calling in sick. So everybody got the flu. And if the shutdown were to continue further, this white curve would just keep trending higher. And so while people say, oh, we have a lot of the work has been recalled and so on, without pay, it's very hard to keep people in the workplace, and that started to cause all sorts of disruptions. For those who traveled in recent weeks, know that it's been pretty bad, and which is getting worse. The chart on the right from Goldman Sachs shows the how payments to government contractors declined pretty much across the board dramatically in January, and that basically spread throughout a number of business sectors and so on that support the government. There was an impact on small businesses, particularly in the D.C. area and other areas as well. That again, pretty hard to, other than anecdotally, to tease out to actually see the impact, but it's definitely there. So these are just some of the disruptions that we saw, during the shutdown. Here's another disruption, which is not obvious, but it's there. Basically, the Treasury was accumulating a lot of money that it kept with the Federal Reserve. And when the year started last year, the balances that the Treasury kept with the Federal Reserve kept climbing, and at this time they're supposed to start spending that money, but they obviously are not, because they're not allowed to, or they weren't allowed to until the shutdown ended this weekend. And by holding a lot of cash with the Fed, what it does is it sucks out deposits from the private sector, putting them at the Fed, making them unavailable to the broader monetary system, to the private sector, and it's a form of tightening, and people don't think about it, but it is a form of monetary tightening. So, with the Treasury keeping a lot of cash at the Fed, it's basically deposits that normally would sit at the banks, and those get sucked out and get kept at the Fed, and it reduces the private sector deposits. It actually had a strange effect on the Treasury bill markets, because with the Treasury sitting on all this cash, they were not planning to issue as many Treasury bills, and so they created a little bit of a shortage of Treasury bills. And if the shutdown were to continue, you would have more of a shortage of Treasury bills. So it's just one of those subtle things that was taking place that people didn't often consider. If the shutdown were to continue, and there is a possibility that it could resume, there's a potential for some serious disruptions, or massive disruptions. For example, the map on the left shows states that are really dependent on the federal government for things like food stamps and child nutrition programs, free lunch and so on, for low-income families. And basically that funding for these programs ends in February, which means that if the shutdown were to continue, or if it resumes, we could have a situation where states are unable to fund, SNAP with food stamps and child nutrition programs in many parts of the country, which, as you can imagine, is a disaster. It could have tremendous implications for the country. The chart on the right is another kind of ticking bomb in case of a prolonged shutdown, and that is this is the profile of tax refunds. And again, a lot of low-income families rely on the tax refund that comes in early in the year for their purchases. I mean, that's where they get a cash infusion, and they can make some purchases that they need. And while the federal government recalled the IRS employees to come in and work on tax refunds, that process was increasingly being slowed down by just people not willing to work for no pay. And so you could have a disruption in that sector where people are not getting their tax refunds. Again, another significant impact on the nation and the economy. So let's talk about consumer confidence. As the shutdown became more prolonged, people turn the TV on every night and see even if it didn't impact them personally, Americans got nervous, and in particular, they're not as concerned about their current situation. They were becoming concerned about their future and what's going to happen going forward. So the two charts on the left side are the University of Michigan Consumer Sentiment Index. The one on the top is the kind of the general index of consumer sentiment. The one on the bottom is the expectations index, how people think about their situation going forward. And we got a confirmation of this trend in the Conference Board Consumer Sentiment Index, which is the middle two charts. And as you can see, the one in the lower middle, this lower middle one, shows consumers are really worried about the future. And that 3-month decline on this, or the 2-month decline on this, is the largest in over a decade. So Americans got very uneasy about the shutdown, and when consumer confidence declines, you could have all sorts of knock-on effects going forward that could last. The chart in the upper right shows kind of the latest survey from AP. Things in the country heading in the wrong direction, and you can see all of a sudden this change as more Americans view the country heading in the wrong direction. Finally, the chart in the lower right is the University of Michigan. When they sent out the survey for consumer confidence, they asked if people want to put a comment about news that they've seen with regard to government policy. And what you see there is when President Trump got elected, there was a massive spike in people putting in voluntarily putting in positive comments about government policy. And then another spike took place when there was the tax reform took place at the end of 2017. And then when the government shutdown started, these voluntary comments all of a sudden started to drop off rapidly. So what this tells you is that even people who were very supportive of the federal government, early on, were becoming nervous during this shutdown. We're also seeing some concerns in the business sector. So if you look at the chart on the left from Moody's Analytics, it shows business sentiment dropping off to kind of multi-year lows. And again, you can see that there were really three events that knocked down this confidence. The trade war was obviously the big one, and tariffs and so on, and the threat of more tariffs, and then the corresponding slide in stock prices spooked a lot of businesses and continues to worry a lot of businesses. And finally, the shutdown was kind of the nail in the coffin here, as a lot of businesses got nervous. The chart on the right is the Philadelphia Federal Reserve index of service sector businesses in their region. And this particular one shows it's a new orders index. It tracks new orders in a service sector, so things like consulting services and so on. And this drop was unusually sharp, and some believe that a lot of this was due to things like government contracts, IT contracts and things of that nature that were put on hold or canceled, and so new orders index just went into contraction territory, and so that really impacted some of the service sector across the country. Manufacturing, on the other hand, remains in decent shape. I mean, definitely slowed down due to the trade concerns. But the manufacturing sector, I don't have a chart here, but the manufacturing sector remains pretty stable and in reasonable shape. So the slowdown took place in December before the shutdown, but it has since stabilized, and so we don't see as much of an impact on the manufacturing sector. So I get a lot of questions about the stock market and what was the impact of the stock market. And from day to day, you saw some impact, particularly when you had the efforts by different parties in the government to end the shutdown failing. You saw some adjustments in the stock market related to that, but it's hard to tease that out. It's hard to say what's the shutdown and what is really the kind of the bigger picture, which is the global slowdown and adjustment in earnings expectations, which drove the stock market almost into bear market territory in December. And that was early on. It wasn't related to the shutdown, although that certainly exacerbated it. So one of the things that impacted, for example, market volatility was this chart on the left, which is the Economic Policy Uncertainty Index. So you can see that index spiked and this spike is really related to the shutdown. And you can see a similar spike in 2013 when we had the last sort of big shutdown with a lot of uncertainties associated with that. That's when the Republican House basically wanted to defund Obamacare, and that shutdown created a big spike in uncertainty, and so did this one. And that had an impact on the market volatility. So it kept volatility elevated. In fact, you could see VIX remaining relatively elevated even as the stock market resumed, sort of started recovering early in the year. There were some specific market moves impacted by the shutdown. And here's an example on the right, which is companies that provide payday loans to bridge people to their paycheck. Those stocks rallied quite a bit because people saw them gaining a lot of business from furloughed employees as well as contractors. The situation with contractors is much worse because a lot of these guys will never recover the money they lost, and so some of them had to go into debt to get by. But this is shows how the shutdown basically boosted the payday lenders' stocks. So with all the sharp reduction in the consumer sentiment, how did that impact consumption, actual consumption, things like retail sales? And it's not easy to tell what's going on with that. Part of the reason is that the government shutdown itself resulted in less data being released. So we don't know, for example, what retail sales did in December. So it's kind of hard to compare and make some sort of a judgment. But we do have some data. The chart on the left is what's called the Red Book Same Store Sales, and that basically looks at chain stores and says, okay, how were the sales in these same stores? How did they change from a year ago? And basically, going into the holidays, going into Christmas season, sales spiked. People went shopping, and so the Christmas or holiday sales were quite good on average, which you saw that a little bit of a boost in retail stocks. But it started to slow in January, but it's still pretty robust. It's hard to see from this a significant impact on retail sales. However, the chart on the right shows it compares basically the official retail sales data with credit card transactions index year over year, and that definitely says retail sales have slowed in January dramatically, potentially. So it's again, it's difficult to say whether people just stopped using credit cards because they got overextended during the holidays, which happened before. But the decline looks very sharp. So analysts are kind of divided as to what happened to retail sales, during the month. But there's quite a bit of uncertainty around this, and some of it a lot of it could be related to the shutdown. In particular, if you look at the D.C. area, and we'll have a chart on that shortly. The D.C. area spending anecdotally slowed quite a bit. So things were already, if you look at some high frequency indicators, things are already kind of in slowdown mode going into the end of the year. But then they worsened as we got into January. So the chart on the left shows the University of Michigan survey on how people view buying conditions for cars, and that index started kind of tanking at the beginning of last year, and just deteriorated going into January. Some of it has to do with just the cycle. People basically there was a huge inventory of cars that were getting old, and kind of 2015 and 2016 people were replenishing that inventory. In 2017, the hurricanes destroyed a lot of cars, and people went out and bought cars. But the cycle is turning, where demand for new cars has just slowed in general. But people think that a portion of that has to do with the slowdown, with the government shutdown, as fewer people want to buy cars. The chart on the right is a broader kind of a macro trend that basically says, look, if you take into account various surveys and the stock market, and run a regression against consumer spending, you can get a pretty good correlation. You can create an index that is effectively a leading index or tracker for personal consumption in the U.S. And as you can see, that index points to a sharp reduction in personal consumption. Whether this actually occurs remains to be seen, but as you can see, this correlation is pretty good, and by all indicators, consumption has slowed, which consumption obviously is about 70% of the GDP growth, and so this has a massive impact on economic expansion. So labor markets. What do we know about the labor markets? Well, we know that as the shutdown progressed, government workers all went out onto job websites and started clicking. They were looking for work. Some were looking for temporary work. Some were looking to just change, because there's only so much you can push people, and if they're talented, they can find work in the private sector, and get away from this madness. So people went looking for work. Anecdotally, we know that the TSA workers would call in sick and instead go and drive Uber, to make extra money, or some of them would go and wait tables, work in restaurants at night, and that obviously was part of this disruption that we saw, where the fear was that you get TSA workers that are really tired and can't focus during the day. And given that there weren't enough of them to begin with, because a lot of them just called in sick, the ones that did come in would be distracted, and you could have some dangerous situations there. But this is clear evidence that government workers went out looking for work. One thing that economists are talking about these days is that over a longer term, you could see significant brain drain from the government. If you're an engineer, a scientist, a technician, or medical researcher, the job market is so good in the private sector that you could say, look, I don't need this nonsense. I'm underpaid to begin with, and now you're withholding my pay for and making the situation's uncertain, so I don't have certainty about when I'm going to get paid. Forget this. I'm going to go and work in the private sector, and so you could have a situation where federal employees are just moving out of those jobs, and that could create longer term problems for the federal government, including things like it would make it difficult to recruit people because they'll say, wait a minute, you talk to me about stability problems in the private sector because they could have layoffs and so on. But the public sector is scarier. Federal employment is a scary situation, so I'm not going to do this. So it has a potential for long-term implications. But so far, we haven't seen any impact in the labor markets of the shutdown. And again, partially because a lot of these workers, rather than filing for unemployment claims, a lot of people did file for unemployment claims, but a big number, rather than filing for unemployment claims, just went and got jobs, temporary jobs such as driving a cab or waiting tables to make ends meet. And so what we saw recently, and we'll see what happens, later, but what we saw recently is that the initial unemployment claims, so this is the applications, initial first-time unemployment claims, filing for unemployment, dipped below 200,000 people, and this is a weekly indicator, and this is the lowest since the 1960s. So obviously, so far we haven't seen a visible impact on the unemployment. However, if you look at the shutdown in 2013, which is the chart on the right, you can see that big spike there in initial jobless claims. So we may yet see some of the impact, but this labor market is so strong that it could easily absorb government workers who want some part-time work or just leaving and finding other jobs. So no issues here. And just to add to this, today we saw this ADP private non-farm payrolls report, which shows that at least in the private sector, job creation continued at a really healthy pace. Created over 200,000 jobs in January in the private sector, and that was much higher than expected. So that the labor market expansion continues. So let's look at the overall GDP impact. And there's a little bit of a debate around what that would be. The chart on the left shows the impact on the GDP, and most economists were basically saying, look, the GDP was around, without the shutdown, would have been around 2% for the first quarter. But as the shutdown went on, it basically ate into the GDP growth. And you can see the chart on the left from Scotiabank shows how each week would reduce the first quarter GDP growth. So now that the shutdown is supposedly over, the chart on the right shows, this is from Oxford Economics, it shows where we are, assuming that this thing is not going to resume, the shutdown is not going to resume. So basically what Oxford Economics is saying is, look, we were forecasting GDP growth, or the consensus GDP growth was around 2% without the without the shutdown. The shutdown up to now brought it down to 1.8%. So it's definitely a decline, considering that we were sort of growing at 3%, last year, 2.5 to 3%. But it's not a significant decline in the bigger scheme of things. So if there's no more shutdown, the government remains open for the rest of the year. This particular analysis says that yes, we took a hit, but it's not that drastic. However, if we stay shut down through February, or the shutdown resumes, you can see the impact becoming more dramatic. And if the government is shut down for the first quarter, it's even bigger impact. And some people would say if the government stays shut down for much longer, the GDP growth could turn negative, because it just destroy confidence, and the consumer and the business sector just completely pull back on spending. So there's this uncertainty associated with the situation. But so far, it's not a dramatic impact. Looking a little deeper into this, the chart on the left shows the Goldman Sachs current activity indicator, which is it's effectively a more of a real-time GDP tracker that allows them to look at all the different indicators and say where is it tracking as far as the GDP. And you can see that in January we dipped kind of below 2%. But what's more telling is the chart in the lower left, which is the same. Was also from Goldman, but it splits the impact on their GDP tracker into hard data and soft data. So hard data meaning official government data, and soft data things like surveys. And you can see the kind of the hard data so far remaining relatively stable, at least the hard data that we have. But the soft indicators tumbled. We hit the lowest level since before the 2016 elections, and so this divergence between soft and hard data has ended, and now the soft data crashed onto the hard data effectively, and that's partially the result of the shutdown. And things like consumer sentiment that we saw earlier is in that red line. It's built into that red line. The two charts on the right show the economy of the Washington D.C. area. Washington D.C. is the fifth largest metropolitan area in the United States, and so if that economy takes a hit, which it did somewhat, but if things get worse, it could have an impact, a meaningful impact at the national level. And it's the top chart basically shows that economy has been growing pretty rapidly, the DC area economy. And if it slows, you could see a blip in the national economic growth data. So one thing is worth pointing out is that an economic squeeze due to government, federal government, basically not spending as much in quarter one. Some of that we get back in the second quarter because the government is kind of forced to spend that stuff that didn't spend it. at least a portion of it they will end up spending in the second quarter. So we get some of that loss in the GDP in the first quarter. We get that in the second quarter. However, the net impact is still negative, and you can see that the chart on the left from Merrill Lynch shows that yes, you get some of that back, but depending on how long the shutdown was, the net impact, which is the green bar, is still negative, and you're still at net loss to the GDP. And so if you look at the chart on the right, that is basically the forecast by quarter from Morgan Stanley. And it says, okay, so we dropped from what would have been about 2% in the first quarter to about 1.7%. Some people say 1.8, but it's around that number. And you can see that one of the things that's missing is government spending, which is the orange component of that bar. This orange component. And you can see some of that is coming back in the second quarter as the government kind of ramps up its spending that it didn't do in the first quarter. It comes back and spends in the second quarter. However, there's this hangover effect in the third quarter where Morgan Stanley is basically saying the third quarter could look really ugly because basically a pullback in consumption. And it's a kind of a slow knock-on effect, bring the third quarter GDP to 1%, which is pretty low for the U.S. It's okay I think it's pretty reasonable for other countries like in Europe and Japan, but it's for the U.S. it's pretty low. And so the overall impact they view as pretty meaningful of the shutdown, combined with things like trade uncertainty and the global slowdown. There are other forecasts. The chart on the left shows one particular forecast from macroeconomic advisors that says, look, this Q1 GDP will be 1.5%. Rather than kind of 1.7, 1.8 that we saw earlier, we're talking 1.5%. And again, that's pretty low for the United States. I think that's the lowest we've seen since 2016, if that's going to be the case. So it's a bit of a concern. And the chart on the right shows how different groups changed their forecasts for the first quarter due to the shutdown. So we have Barclays, Bank of America, Merrill Lynch, J.P. Morgan, Morgan Stanley, all adjusted their forecasts, some more than others. But depending on which economic group you talk to, the adjustments vary a bit, but a lot of them sort of between 0.2% of the GDP to 0.4% of the GDP so far. But obviously, if the government resumes its shutdown, these things will just keep moving to the left. So what was the political impact? And the political impact here is pretty obvious. So President Trump's approval ratings took a hit, a significant hit, and many people view this as the reason why he abruptly ended the shutdown, is that he was seeing this impact, it's basically how bad can it get, and so it's that was one of the drivers behind the end of the shutdown. This, by the way, is a compilation of all the available presidential approval surveys. So finally, is this thing over, right? And people debate, what what will happen next. If you look at what President Trump's been saying, is basically saying, look, I don't think that I'm going to accept whatever border deals that will come out of Congress. And so the president is pretty skeptical. And if you look at his tweet, which is recent, he says, just listen to what I'm saying, we're getting badly hurt by the shutdown, with the understanding that in 21 days, if no deal is done, it's off to the races. And what does it mean, off to the races? Another shutdown or something else, right? It could be he's going to use emergency powers to find another source of funding for the border wall. We don't know, but there's enough uncertainty around this where it will keep people on the edge, including government workers. So that's basically it. And so maybe we can start with some questions. By the way, I just wanted to say I want to thank all of these different organizations for providing charts for this presentation.
Thanks very much, Lev. Always appreciate your fantastic insight. To your last slide regarding how likely another government shutdown is in 3 weeks, the spending bill that was approved was just a temporary spending bill, so that they do have to go back to the drawing board, correct?
Yes, that's right. And so, in whatever 2.5 weeks, we're back to square one. And here's kind of where the probabilities are right now. There's people are citing about a 25% probability, 1 in 4, 25% probability that the shutdown will resume. So basically, the president says, I'm not signing this stuff, and we're going to go back to and shut down the government. So there's about a 25% chance of that. The two other possibilities are that one is that there is actually a deal worked out that includes some funding for border fencing, or border wall or whatever fence, and President Trump says, okay, that's enough, that's good enough for me, and signs it, and that's the best outcome if we can get that. And the third possibility is that basically the president signs some funding bill that does not include border funding, but includes some sort of border security, and then declares a national emergency, which he has the right to do, and goes out and basically takes money out of the Pentagon and uses that to build a portion of the wall. And that particular outcome is an ugly one, because it's going to create more conflict and potentially end up going through the court system and being challenged. So those are the three possibilities.
Isn't there also a possibility that there's another short-term funding solution put in place?
Yeah, there's definitely possible that they will simply just kick the can down the road. I haven't seen that possibility discussed, but it's definitely possible that they will just kick it down the road for another 3 weeks and just keep doing these short-term resolution funding.
Right. What happens to small businesses during the shutdown and their ability to get loans?
Yeah, it was an issue for certain specific areas, right? So, SBA loans were people couldn't get those, and so you saw anecdotally, businesses that were about to close on property or needed to buy equipment or needed to do certain things, and they were basically they were about to receive SBA financing that got delayed, and so that those things were put on hold. But there are other businesses in particular related to government contractors who needed financing to get by, and some of them had trouble getting that financing. There were farmers who had a lot of trouble getting financing for their to buy crops, basically buy seed, right? And that was a real problem for a lot of farmers, and some farms may be in trouble because of that. Banks were pretty accommodative, but there were a lot of these farmers depended on federal government programs to help them through, and that just wasn't there for them.
How about banks that work with SBIC funds?
SBIC funds, the delay there, a lot of the delay was just getting SBIC funds approved, and so they created a massive backlog of SBIC funds that are just sitting there in limbo, that haven't basically looking at deals and saying, "Oh, I can finance all these businesses," but can't do it because they haven't got the SBA approvals. And so that just created a backlog, which delayed, kind of more middle market, smaller business debt loan approvals. But those, I think there's going to be a stream of those coming through as the SBA gets back to work, assuming they're back to work. If they're not functioning for longer, if the government shuts down again, it could create a serious problem for a lot of small businesses.
I also understand that the government shutdown impacted the ability for foreign students who went to school here in the United States, who graduated in December, to have their OPTs processed. So delaying their employment starts, which impact businesses, obviously.
Yes, and a lot of them are worried about not being able to be able to stay in this country because of that.
Right, in general. What vulnerabilities on a more macro level did this shutdown expose or highlight?
So one of the things that some people are talking about is, the key infrastructure of the United States, in particular airports, right, TSA workers and so on, are exposed to shutdowns. And you could have a situation where, if it goes on for much longer, flights, and we already saw that in LaGuardia, right, flights getting canceled and delayed, and security gets compromised. So it becomes a serious national problem. Talk about national emergency. That's a national emergency, and so there's been a lot of talk about going back to the drawing board and potentially privatizing some government agencies that are vulnerable to shutdowns that are important, and privatizing airport security could be one of those. There are others that got exposed. For example, the Coast Guard, right? Coast Guard folks didn't get paid because they report to Homeland Security rather than the Pentagon, and so they didn't get paid, and it was a real problem for a lot of service people in that sector. And again, Coast Guard is a critical part of U.S. infrastructure and defense. So that's another vulnerability that got exposed.
And the Daily Shot is a small business. How did that impact you?
It did, and one of the issues was that basically a lot of the government data that you normally rely on to assess the direction of the economy and where the markets are going to go wasn't available. So we don't know, for example, factory orders in December in the United States. We don't know what were the factory orders, capital goods orders, things like that. We don't know a lot of other sort of related data that the government never released because of the shutdown. And so for the daily shot, it's important to track real time, to track how this data progresses. We had to resort to alternative data sources, less reliable data sources, and estimate a lot of these trends.
Interesting. Shifting gears for a minute. Last year, we did a fantastic session regarding volatility. Actually, 2 sessions on volatility. And the first session that you did was well before all of the volatility started. So it was really a real predictor of what was to come. Obviously, beginning of the new year, things have calmed down a little. But are we done yet?
The key data point ahead is going to be the trade situation with China. If that gets resolved in some way, and the risk of additional tariffs goes away, I think the market volatility will ease somewhat. It won't be as low as what we saw in 2017. That was an outlier. It was ridiculously low, but it's not going to be as high as what we saw in December or part of January or last year in February. Mm-hmm. And that's because a lot of these scary events have already materialized. They're out there. And so the big uncertainty right now is trade. Now, with the Federal Reserve today took some of the volatility risk out of the system because the Federal Reserve is now saying openly, look, we're on hold. We're in a holding pattern. We're in a risk management pattern. We're not going to raise rates for a while. We're also flexible on balance sheet expansion. We're not, we may choose to stop rolling off securities from the balance sheet earlier than people thought, and so that calmed down the market, and that took part of that risk out. And so the only key remaining issue, other than another shutdown, remains the trade with China, because that has a huge knock-on effect on global growth. And while a lot of U.S. investors are kind of like, who cares about the rest of the world? Well, when you saw what happened with Apple, for example, mm-hmm. or Caterpillar or NVIDIA, or I can name a bunch, right? They all got hit by global growth, in particular China. And so, that trade stabilization situation, that is really important to iron out that volatility. If that gets solved, we're in good shape. The volatility will decline. If it doesn't, then all bets are off.
Do you have any data that shows how the tariff war is impacting China relative to how it's impacted us?
I do. And if you look at Chinese data, it's been extraordinarily weak as far as, particularly with trade, and it basically says, starting about the middle of last year, it started to deteriorate, and Beijing now is in full throttle in trying to put stimulus measures in place to try to rejuvenate growth. They're going to implement what's similar to LTRO program that the ECB did, where trying to incentivize banks to lend, especially to smaller businesses, and to try to boost the economic growth. Mm-hmm. But it's a real concern.
Another reason why there's more optimism that China may be more willing to negotiate.
Yeah, at the same time, China is optimistic that the U.S. is more willing to negotiate because They saw what happened to the stock market in the U.S. and they know that the Trump administration is very focused on the stock market,
Right.
and so their view is they have some leverage because if the U.S. doesn't play ball, the stock market will tank again, which they feel that. So both parties are very incentivized to make a deal.
Yeah, it'd be interesting to see what kind of deal. All right, I think we're up on our hour. Lev, again, we appreciate the information and insight. It's always fantastic to hear from you. And we'll try to do this again in another 6 weeks or 8 weeks, and see what the future holds.
Sounds great. Thanks, John.
So everybody, thank you very much for joining us today. If you do have any further questions, please feel free to email them to us at webinars@starmountaincapital.com. Also, if you have any ideas regarding future webinar topics, please feel free to send them to us, and we'll be happy to consider them. We do look forward to everybody joining us again in the future. Thanks, everyone, and enjoy the rest of the day.